It's time now for today's strategy session. Stocks little changed after 3 days of gains as investors digest more corporate earnings and the latest commentary around the trade war. Joining us now with more, Michele Schneider. She's the chief strategist over at MarketGauge.com. Michele, it's great to have you. And you sent over some really helpful charts comparing this moment in time to what we've seen in other moments of intense market volatility, including 2022. What are you seeing now that you've seen in the past that indicates to you that there may be more pain coming for this market?
Well, we don't really know about the pain part yet, and that was the whole point of the comparison. And by the way, good morning to you guys. In 2022, after we had a tremendous aggressive amount of rate hikes from the Federal Reserve and a big down move, in October, if you're watching the gold to silver ratio, which I watch all the time because, it's certainly been bullish gold for years, and now maybe it's peaked out a little bit. I was waiting to see what would happen with silver. So in 2022, it was really interesting because right in October, that gold to silver ratio peaked at around 95, 96. At the same time of that peak, the next day, what started to happen was that silver started to rally, which would then began to outperform gold in terms of relative ratio, number one. Number two is it looked like the TLTs bottomed at that particular time. The dollar certainly had started its decline after having a peak high at around 114. But the SPY, even though it was trying to bottom, it actually chopped for months and months until the Fed policy really changed from aggressive rate hikes to pause. So now if we fast forward to 2025, we're watching the same kind of thing potentially unfold, right? So for the first part of it, gold to silver ratio went up to like 105, 106, which was tremendously high. That was the whole race into gold as a safety play. Now silver is trying to actually rebound here. We're not sure yet, and that's going to be a key recessionary indicator, but that's number one. Number two is the TLTs are also trying to bottom. Before Fed policy starts to change from stay the course to possibly lower, we don't know that yet, but that would be important to keep an eye on. The dollar, of course, has already been in decline. However, it can have these little pops here and there. And finally, the SPY, if it has bottomed, it could chop around for a while, which would kind of match what we saw in 2022, is that it would take some time, but then by the second half of the year, we could start to see it catch up.
And so people, I think, want to know, with the additive of tariffs within the mix right now, that has certainly been the kind of self-induced portion that has been tough to really know exactly what the course of direction is there. The relief would be around, okay, if we do see any type of negotiations come forward, then that would mean perhaps rally back on, we can get back to some of the normalcy. How does that additive make the analog that you were just breaking down of the historical element to all of this? How does that additive either change things dramatically or keep things the same to a certain extent?
Well, that is the question, right, Brad? I mean, that's what everybody's wondering. For example, I've been seeing a lot of buzz about this Zweig breadth thrust, which triggered this week, which has been 100% accurate in calling a bottom in the market. But of course, we're in a completely different world right now with higher valuations and tariffs on the table. So one would have to assume that if you step back from all of that, what these indicators of the gold to silver ratio, if silver can hold up, like I said, if bonds can bottom and the SPY can hang in here, probably is projecting that at some point the tariff negotiation will result in something that at the very least gives people more confidence that the worst is behind us. We don't know that yet. So that's why I wouldn't run in gangbusters, but at this point, I would certainly watch to see how all these areas unfold.
One of the correlations that my sources have been flagging this week, of course, is stocks and bonds. And if yields don't decline when stocks sell off, investors, maybe they'll discover that they've been kind of paying for a hedge that isn't working anymore. That is from a note that I was reading this morning. To what degree do you look at that relationship, and what is it signaling to you at the moment?
Well, it is a very key relationship because it really gives us an assessment of risk on or off. And generally, you want the SPY to be outperforming the long bonds if you're going to look at SPY versus TLT. Yet, at this point, The TLT, they're in a battle, the TLT and the SPY in terms of its ratio of performance. So essentially, what you really want to see is even if the rates come down, you want to see the SPY start to outperform stronger. If the TLTs start to outperform because the rates are cut and it doesn't help the SPY, that's really going to be not only a risk-off situation, but potentially another nail in the coffin towards recession. But again, these are all unknowns. These are just things, good signs to watch, so you're not as headline focused and more on these relationships that are so important.
One relationship that is perhaps the Roman Empire for much of the markets is the relationship with Fed Chair Jerome Powell, and trying to understand how a data-dependent Fed is going to start to read through prints that could start to show hesitancy or increased hesitancy on the consumer side, and then how businesses are also positioning what their headcounts look like if there's a material change in employment. How are you looking through some of the hard data that's going to start to come out as well next week to really assess how the Fed may start to change its tenor?
Well, they're going to look at labor. So right now, jobless claims that we've been seeing in the last few weeks are really not flashing any kind of warning. We have unemployment, of course, in the first week of May. That'll be key. We've seen the inflation numbers come down to a degree, but not under the 2% that the Fed wants. And of course, the tariffs and supply chain and what's possibly happening in terms of goods coming into this country being blocked, that could be inflationary, which is exactly what Powell has been saying. So it's hard to say. I think if they see things really breaking, I mean, we're already seeing housing sales going down, businesses having a lot of issues, bankruptcies starting to peak up, that could supersede their typical dot plot. But again, that's why I like these relationships, because the TLTs haven't actually shown us yet that the Fed is willing, other than the natural attrition of the rates going down while people are starting to buy bonds in anticipation, that they're ready to do that. And yeah, they're going to be really careful about inflation. And let's face it, right now we're in stagflation. That is a very hard economic situation for the Fed to set monetary policy on.
Michele, great to see you this morning. Thanks so much for taking the time.
Thank you so much for having me.